So let's turn now to Sandy Villere to talk more about the market and why it's so confused. He is a partner and portfolio manager at Villere Company. Sandy, welcome. Nice to have you here.
Thank you, Sue. Appreciate it.
I think that Bob Pisani really said it the best. Why have things gotten so, quote unquote, weird in August, or perhaps better said, so confusing?
Yeah, and August is a tough month for the market. I think it's the second worst for the month for the market in throughout the year. So it just seems like volatility's a little bit escalated. But yeah, you've got a lot of things going on, from earnings to the trade war and certainly the Fed. So a lot of things that we're trying to keep our eye on that are creating a lot of volatility, especially trade war related.
I was going to ask you, which is the most important to you of those factors that you just mentioned? Which are you watching most closely, or which is the greatest variable for you?
Yeah, so I'm a very bottoms-up oriented stock picker, so I'm looking at earnings very importantly. But earnings have now passed us. We've had about 90% of the S&P 500 report earnings. So looking forward, I'm focused on the trade war. And what's ironic is that the trade war and the Fed really go kind of hand in hand. The kind of the uglier the trade war gets, or the more it escalates, the higher the likelihood that the Fed could potentially cut rates in September and maybe October.
You know, there's two ways to think about that from the analysts that I've been talking to. One, the trade war, if it continues and stretches out or becomes even more acrimonious, would force the Fed's hand to cut interest rates. I talked to another analyst who said that would really bother the market because it means that the Fed is indicating that things are worse than we think. What do you think of that argument?
Yeah, and they're supposed to be totally independent, and I believe the Fed completely is. But as the trade war escalates, then you're seeing already, we've got 3-year lows in manufacturing, you've got inflation that's extremely low, and you're seeing growth slow down. Just looking at earnings, year over year are going to be negative when you look year over year just at the second quarter reporting. So if the Fed is truly data dependent and they're looking at some of those outcomes from the trade war slowing on all sorts of fronts, then they're going to have to act.
And then the bond market seems to be telling a different story, pointing perhaps to a recession. How are you interpreting the bond market and interest rate action this week?
Yeah, and the bond market always seems to be a little bit smarter than the stock market. And so you're seeing the 10-year down at a 174, and then the 3-month is up at 2%. So that is an inverted yield curve, and oftentimes an inverted yield curve can predict a recession. So it makes me a little bit nervous. But for investors in general, when they're looking at where to place their money, you look at the 10-year Treasury at a 174. The S&P 500 yields about 2% on the index. So kind of makes stocks look attractive.
Indeed. Thanks so much, Sandy. Great to have you with us.
Thanks for having me, Sue.
Sandy Villere with Villere Company.